Good morning, everybody. Actually, maybe afternoon or evening when you decide to watch this video. My name is Andre Beckles, and I am a financial consultant with Harare Wealth Management. And this is Pump the Brakes. If it's your first time, welcome. If you're coming back, welcome. Uh, a very abbreviated show. Today is August the 5th, and I want to jump on very quickly because I know people may have questions and I hope to have answers. With that being said, the questions really center around why I woke up very early this morning. I had gotten a push from my puppy. Her name is Serafina, and she's like, "Oh, you got to take a look at the markets." I'm like, "It's 2 o'clock in the morning." So when I jumped up, I looked at the markets overseas and I saw that Japan, the Japanese market, was down about 12.5%. I'm like, what is going on? I know the markets, capital markets over there had raised interest rates last week, which is quite different from us. But their interest rates were basically at zero at that point in time. And there's a lot of minutia of what's going on in Japan and their economy. Not that it's weak, it was just that they're trying to slow it down because it had happened to be strong. But really, the nature of this video does tie around that because if their markets are down 12.4%, and if we had looked at the domestic markets here in the United States, they were down roughly around 1 and change 2% the last trading date, which would have been Friday. So market volatility is really the nature of this podcast, and I really wanted to talk about what is really creating the volatility in the marketplace. So it's not just the heat of the summer, but it could be, getting to many traders, institutional money managers' brains thinking that it's necessary to do certain things to get what they want. And what is it that's creating volatility? Well, last week, Friday, the Bureau of Labor Statistics had released the July unemployment report, and the numbers as far as how many jobs were added for the month of July was about 114,000. June was revised to 179,000. If I look, May was 216,000. So the estimates for the month of July were analysts economists were expecting somewhere around 185,000. So definitely there's a gap there. And what you're basically seeing is a slower economy to a certain extent. And that's when the wheels all fell off and certain areas, especially tech stocks, were sold off because they tend to have more risk associated with them. So you would have seen that marketplace was down more so than anything. And sometimes when, I try to let investors know you shouldn't be, if you see the market's down 100 points, you got to really take into consideration at what 100 points from that is minuscule. But I also know that we live inside of a society that sometimes we forget that markets don't just go up, they can go down for certain reasons. So with a slower job report than normal, and then estimates, I should say, you have people basically getting jitters of inflation. Well, I stopped using, or inflation, I shouldn't say. Let me backtrack that. Recession. I don't see where we're heading into a recession. Basically, recession, you're going to see slower growth based on, let's say, GDP, gross domestic product, 2 quarters of slower growth there. I don't think we'll see that. We have not seen that. But what we do see is the effects of higher interest rates. Now, interest rates are nowhere where they were last year at this point in time. They have come down gradually. If you're buying a home, you may not think so. If you're paying credit card debt, you may not think so. But they have come down from their heights. Now, the Federal Reserve, which handles monetary policy, they met last week, and actually they met on Friday. So it was the jobs report. Sorry, they met on Wednesday. The jobs report was Friday. And prior to that, they had mentioned, hey, we are looking at easing meaning, you know, lowering interest rates, but not just yet. Maybe down the road, meaning possibly September, October, November, but there's no guarantees because what they're looking at, which was the jobs report, that is key because of employment or unemployment is one of the many factors that the Federal Reserve looks at. They also look at the wages, how much wages are going up or not going up, because that gives you an idea of what can be inflationary versus what's not inflationary. But I'm not going to get too technical. Basically, they said not just yet. The markets looked at that and said, well, they're not exactly saying no. So there is a possibility. I know the markets have shot up a lot right after the uh, the announcement that was not going to be a rate increase or decrease. They listened into the conference call with the Federal Reserve chairman, and then we weren't up as much. But pending lower interest rates, that is the possibility. There's a term of throwing out the throwing out the your toys out of the pram, or I'm sorry, what do they call it here in the United States? Pram is something that they use over in Europe. Uh, Basically, kids throwing their toys out of, let's say, their bed. I can't even think of the term right now, so I'm not gonna. But it's kids being irate. With that being said, that's what I see inside the marketplace. The sell-off in Japan basically was the fear of a recession in the United States, since the United States hadn't gone into a recession and it's one of their bigger trading partners. That was one of the fears. And 12.4% again, as I said, that's a lot compared to if I looked at the marketplace as I jumped on to do this call, we were down maybe about 2% in certain indexes, so indices. So I would like to let everybody know, relax. There's no reason to think that the world is coming to an end. And I actually would hope that maybe a trader or two will listen to this, where this is posted, possibly on LinkedIn. I do get some traders that listen to my podcast, and it's like, hey, relax. You can't force upon the Federal Reserve to cut interest rates because you want it right now. There's not going to be an emergency meeting because there is no emergency. You still created 114,000 jobs. If you see a slower number than what we've seen in the past few averages, then that is the effects of raising interest rates. It is a lagging situation where eventually it does help slow down the economy. That is what it's supposed to do, to cut inflation. So that is what I really want to talk about. Pardon my mic, with regards to the unemployment report. We talk about inflation. Inflation is at 3%. The Fed kind of wants that 2%, but they're not going to wait until it gets to 2% before they start lowering interest rates, should that be the case. That has been stated already. The bond market, I did notice this morning, again, we're August the 5th. I did see that yields had gone down quite a bit. So you also have the effect of the Federal Reserve can lower interest rates, but the U.S. Treasury market can do just the same. So you have more than one factor when it comes to interest rates, and I'm seeing that interest rates have definitely come down over the past few days. And this morning inside the bond market, early on, I definitely saw that rates were definitely lower. Where I'm seeing the sell-off, I am seeing sell-off. If you look at 2% being a sell-off, I am seeing that small cap stocks have definitely sold or down roughly about maybe 4% on Friday, and I believe they're hovering around 3-4% in the negative market today. They were just up 11% for the month of July. So keep that keep that in mind. We were kind of flat, but that's where they were for the month of July. Had the largest movement, and people were moving a lot of money into small cap. So that's what I saw there. What else? I saw consumer goods, as far as another area where stocks are being sold. So when you see the market being down, 2%, whether it's down 100 points, 200 points, it's by and large, it is tech. But I also saw consumer goods. I saw the oil price, the barrel of oil being down about 75 to $75. Well, it's good. When you have a slower economy, you have less demand for oil. And I also saw it for natural gas just as well. So that's a good thing for consumers. Nobody wants to pay more. So we look at that. Did want to touch on two things. So pardon me, I just want to look at where were we, coming into Friday. Where did we close? The S&P 500 as of Friday, so that would have been what, the 2nd or the 3rd of August, was up 13% year to date. The Dow Jones was up, say, about 6.6%. The Nasdaq was up 12.2. The Russell 2000 was up 5%. Emerging markets up 5.7. Excuse me. So we definitely still have positive numbers year to date. And I just think that this is a little retrenchment. The market was definitely frothy, meaning in the positive sense. It had been chugging along in a positive sense. So if I remember speaking to one of my clients, Miss Diane Sichi last week, she says, hey, when are you going to do another pump the brakes? I says, during the summer, it was really not a lot to talk about. It's kind of like a little seesaw effect. So I don't always come on if there's not anything to really provide information about. I think that if you do a podcast, it should have something that's very enlightening. It shouldn't be redundant. So, but I planned on doing one at the end of the month, and heck, this is going to be the one for the end of the month. Silver lining. As we close out, silver lining is basically if you are investing, whether it be in your 401k, investing systematically in your IRA, or if you have a non-retirement account and you're always adding money, well, this is a great time to add money into those investments. If you're doing it systematically, then it's already on autopilot. You don't have to think about it. But if you're not, then this is a good time to establish that and add money into it. If you are an investor where your money is already there, hey, I just gave you numbers. It is a positive market year to date, so it's not a negative market. Let's, take a deep breath and we move on. I can't tell you exactly where we're going to end up at the end of the day. If I take a quick look, it's now roughly Eastern Standard Time. The Dow Jones is down 2.5. The Nasdaq is down 3.8. The S&P 500 is down 3%. And if I look at the Russell 2000, that's your small caps, it's down about 4%. So we're not down 12, just about 12.5% like Japan. Like I said, I think that was a lot of overselling in their marketplace. We shall see. But this has been another version. I hope that you enjoyed the information that I provided you. Another version of Pump the Brakes. I didn't ask you to like, subscribe, and share at the beginning. So if you've been here, if you want to see more of this information, you want this information shared with more people, like-minded people that want to know about financial markets, financial literacy, like, share, and subscribe. It helps the algorithms to get this information around. And I thank you for that. Until we speak again, peace, love, and blessings. And we look forward to all the positives that come in the future. So take care of yourself. Speak to you soon.